On June 30th, China's largest rideshare app Didi was listed on the New York Stock Exchange, becoming the second largest Chinese IPO since Alibaba. However, within 5 days, China's Cyberspace Administration announced the launch of a cybersecurity review of Didi and ordered all app stores to pull the app, alleging that Didi had illegally collected users' personal data. Shares of Didi fell, wiping out a quarter of total market value and taking the stock below the IPO price. Some experts say that the Chinese Communist Party is politicizing its war with America in the capital market. Others say it's tightening the grip on data and Chinese big techs. But why does the Chinese regime punish one of its own tech companies in the American stock market? Hi, welcome to my show. I'm Lei. Despite deteriorating Sino-US relations, a record 34 Chinese companies have raised $12.4 billion in New York during the first half of 2021. This is a huge increase compared with the 18 companies and $2.8 billion during the same period last year. The surge has delivered $460 million in fees for Goldman Sachs and Morgan Stanley. However, more than 2/3 of the Chinese companies listed in the U.S. markets this year have sunk below their IPO price, causing losses to investors. A U.S. law firm is filing class action lawsuits against Didi on behalf of investors and demanding compensation for losses. Didi's drama isn't about data security or antitrust. It's not about competition with America either. Didi's trouble with the CCP is fated in the system of Chinese state capitalism. As various CCP factions clash over power and control, this infighting has now spilled over to the American capital market. I'm making a series of videos on this topic. Let's first look at what Didi is. When Didi was launched in 2012, Uber was already a leader in the global carpool industry. Didi's strategy was to aggressively cut prices and offer lucrative subsidies to drivers and passengers. Its goal was not to make money, but to dominate the market quickly. The company's annual subsidies exceeded 20 billion yuan at its peak. Meanwhile, Uber lost over $1 billion every year during its bruising battle with Didi in China. For 8 consecutive years until 2020, Didi lost a total of 60 billion yuan, or close to $10 billion, since its establishment. It turned profitable in the first quarter of 2021 and immediately went for an IPO in the United States. The major Chinese financial portal Caixin.com commented that Didi's financial data released in its IPO prospectus is a game of whitewashing reports because the calculation method has a lot of room for judgment. For example, the year-over-year quarterly revenue increase of 100% was compared to the worst quarter during the pandemic as a benchmark. In addition to losing money, Didi has been under antitrust investigation by the regime since as early as 2016. Right after Didi announced acquiring Uber China in August 2016, the Ministry of Commerce stated at a press conference that Didi had not reported the acquisition and that the ministry was conducting investigations per the anti-monopoly law. In the following years, officials have made noise about investigating Didi. In 2018, for example, Wang Fuming, Deputy Director of Guangdong Transportation Department, complained on record about Didi's monopoly and refusal to submit its data. It's rare that a government official complains about a private enterprise. In Communist China, they usually don't complain. They order you to change or else they shut you down. In 2019, the Chinese Supreme Court even streamed a live trial of a case against Didi for market monopoly. This public trial seemed unusual, but eventually the noise quieted down. We can see that the regime authorities have been trying to go after Didi for 4 years, but they haven't made a dent. Didi has been successfully dodging the bullet all this time. That makes us wonder. According to CVS investment data, Nearly 20 state-owned enterprises have invested in Didi. This includes the national giants, Bank of Communications, China Merchants Bank, Poly Capital, China Life, CICC Alpha, CITIC Capital, and Ping An Insurance. These state-owned financial institutions provided enormous capital to help Didi stay afloat while fighting Uber. From May 2015 to 2016, before Uber seeded, Didi raised over $8 billion in capital, while Uber China raised only $1 billion. The battle between Didi and Uber was between an American private company and a Chinese company supported by the communist state. It's a fight between their investors and their pocketbooks. Uber couldn't win the battle with an opponent that doesn't care about losing money. In addition to state-owned financial institutions, Didi received investments from private equity heavyweights, Boyu Capital, Sequoia Capital, Hill House Capital, and Primavera Capital. Other notable shareholders are Alibaba, Tencent, and Ant Group. Well-known international shareholders include Japan's SoftBank, which is Didi's biggest shareholder, American company Apple, Taiwan's Foxconn Group, and Singapore's Temasek. Didi also has ties with the Chinese military. The company's president, Liu Qing, is the daughter of the founder of Lenovo, Liu Cuanzhi. Lenovo Group is a computer giant with strong ties to the military, and China's military industry giant, Poly Group, invested more than $400 million in Didi. So Didi is backed by a powerful alliance of both Chinese and international finance heavyweights, and each of the Chinese giants is controlled by one or more powerful princelings and their red families. Now you understand why Didi could easily kill more than 30 competitors, including Uber, in just 4 years, and why it was able to fight off the authorities' regulatory probe for the past 4 years. Most importantly, these princelings and their red families might not be on the same side as Xi Jinping. In fact, Didi is so powerful that it's able to fight off something that even Jack Ma wasn't able to. After derailing the planned IPO of Jack Ma's Ant Group and an antitrust probe, Xi Jinping's officials fined Jack's Alibaba a record $2.8 billion. But the powerful Didi didn't want to put up with that. When Xi Jinping's officials advised delaying IPO in the U.S., Didi and its backers ignored it and went forward anyway. It became obvious that Xi's antitrust investigation wasn't enough to intimidate or strike down Didi. The authority had to use a more powerful weapon, so the charge of a data and national security violation was brought in, and it caused damage. This time, Didi was hit. So you may ask why Xi Jinping is fighting Didi and its backers in the first place. That's a very good question, because infighting and factional struggles among the communist leaders are their way of life and have existed from day one. This is the nature of all communist organizations. If communist leaders don't feel threatened by their people and don't fight with each other, they wouldn't be communists. However, it is very difficult for Wall Street to interpret the political infighting. Unless you've lived in communist China long enough and follow Chinese politics closely, it's difficult to fathom their actions. Chinese may understand it but don't want to talk about it. That's why following my channel and other channels like this one is critically important if you deal with China and Chinese investments. I'm running out of time today, but in my next video, I'll talk about the CCP's political infighting and how it's impacted Didi, as well as what it means to us. Stay tuned, and I'll see you next time.